Hello, everyone. We wanted to take a quick moment to thank you all for joining us today. This podcast was recorded and is made available to you by Whitley Penn LLP and WPWealth LLP solely for informational purposes. The information, views, and opinions expressed in this podcast are general in nature and are not intended to be construed as the provision of financial or investment advice by Whitley Penn or WP Wealth. The information discussed in this podcast is accurate as of the day it was recorded, but may then become outdated over time. Please feel free to contact us if you have any questions, comments, or concerns in regard to the content presented. Thank you again for tuning in, and we hope you enjoy this episode.
Welcome back to Whitley Penn Talks. It's your host this week, Matt Magee. I'm joined today with Bill Weston, a manager on our WPWealth team, and we're going to talk a little bit about debt. All right, Bill, let's set the stage and kind of talk about, from a government perspective, what our government has been doing from a debt perspective.
Yeah, Matt. Thank you for having me. Happy to be here. In looking at different topics and subjects to continue our podcast series, it only seemed natural to have a discussion about debt as we'd been fielding questions from existing clients and investors for years, ever since really the financial crisis, have wondered about the sustainability of the national debt and the continuance to really just build upon that over time. And so, of course, with the pandemic, that's only grown exponentially. I'm looking at what we've done so far and projections for the rest of this year. It appears that just in 2020 alone, we'll be adding nearly $4.5 trillion worth of debt to the balance sheet. And, part of today, what we want to do is provide some perspective, in thinking about the average individual and investor. And they're typically only familiar with things like a mortgage or a small business loan, lines of credit card debt, things of that nature. So a goal of this is to help provide that perspective and really try to get our listeners, give them the ability to really try to wrap their heads around, well, what is trillions of dollars of debt? That just in itself, saying that statement, that's crazy. And to kind of help illustrate with that, what we're going to do is we're going to post some charts and graphs on our LinkedIn. So that may be helpful for those that are more visual learners. So make sure you head to our LinkedIn. It's at WP Wealth, and I think I'll go ahead and post that myself as well on my page. But in starting out, so to help provide that perspective, you need to have some sort of benchmark. And that benchmark needs to provide some sort of level playing field. And the best way to do that, or at least given the data that we have today, is to look at debt relative to production. And so the different charts that you'll see up there, we have national debt to GDP, we have household debt to GDP, and then also corporate debt. And you'll see a divergence in recent history from the financial crisis. You have the consistent application of accommodative monetary policies from the Federal Reserve. You have quantitative easing, bond buying programs, and you have lower interest rates, all really up until recent years when we finally started to raise interest rates once again. Held those.
Yeah, then the pandemic happened.
Cut back down near zero. So you've seen that, or we've experienced that continual growth of the national debt since the financial crisis. On the other side of that, you'll find that household debt to productivity has actually declined. It seems that through maybe our just less frivolous borrowing practices have subsided some, and whether that be due to just those individuals feeling like they were hurt through the financial crisis or more stringent underwriting processes. Likely a combination of the two. We've seen household debt get cleaned up quite a bit since the financial crisis. And then third, corporate debt, you'll see has continued to grow at a steady pace, although it's not even remotely close to the national debt or household debt. It still has steadily increased over time. And so that gives us kind of a benchmark of relative to, okay, well, is this a problem, this national debt that we have? And we haven't seen levels of this debt since World War II. And I think in looking at these charts, it's important to understand the cyclical nature of the charts itself and the different components that make up that ratio. So it's through a recession, or what we're going through today, a pandemic, we're going to have some sort of accommodative policies in place to help get through these tough times. And so it's natural that we're going to continue to accumulate greater levels of debt through that period. So that's your debt ratio, portion of the ratio. But then you also have productivity. I mean, a lot of folks saw the recent report that the most recent quarter, the GDP projections are down over 30%. And now I want to take a quick second to address that, just to make sure that everybody understands that is an annualized number. So maybe a bit of a headline grabber.
33% of one quarter's GDP, correct?
Correct. And so really looking at what from a quarterly decline, we're more looking at 8-9% roughly. So still, it's not good, but again, just to...
It's not 33%.
Yes, that sounds way worse.
Yeah, that seems like the media.
Yeah, get more clicks on,
exactly.
on that story. So I guess getting back to the original point, is this bad? It's hard to say. I mean, we've been here before through World War II, and we recovered from that. But again, I think the nature of this ratio in itself isn't perfect, just because of the environment that we're in. And so, although it seems scary, I think it just comes back to: are we borrowing for productive activities, for innovative, continuing to innovate within different industries? Are we allocating capital appropriately? And at some point we will have to tighten the belt, but at least to get us through this pandemic, we're going to have to be accommodative to help get through that.
Yeah, and it sounds like they're working on a second round of stimulus. A lot of people talk about the government budgeting from getting their fiscal house in order, and that's how a lot of people think of it, because that's how they budget themselves. Same for corporations. Do governments really even need to run a balanced budget with their ability to print money?
That's a good question. Thinking of it in terms of the recovery portion of this. So we're going to have to run. We're going to continue to accumulate some debt in the short term to help get through this. We just talked about that. But coming out of this, part of the accommodative monetary policies is keeping interest rates low. And in looking at the spread, I mean, you see a 10-year Treasury, it's sitting right about 50 basis points, 60 basis points this week. And looking at, relative to historical numbers on future GDP and also just projections in coming out of this recovery, nominal GDP is looking at roughly around 3.74%. So if you're just doing simple math on something of, again, productivity to what the Federal Reserve and the government can borrow at, you're looking at the government being able to run deficits of 3.2%. Again, and that's all contingent on us being able to meet those productivity numbers. But I don't think that's necessarily out of the question, especially in a recovery period. So part of these policies that are in place, they help not just the general public, but they help the Federal Reserve and the government themselves finance debt at a lower rate, making that process a little less painful, especially in the early stages of the recovery. So yes, to answer your question, I think maybe it would be better to run a balanced budget.
But not totally needed, especially given the situation.
Yes, and again, at some point we're going to have to. There is going to be pain in tightening up everything, but in the short term, it appears that we still have the flexibility to get through this.
Yeah. All right. To shift gears a little bit, what does this mean from a capital market perspective?
So, while we're on interest rates, let's start there. It's highly rated, shorter duration issues. It's at least in the short term, they're likely going to stay low and will be low for a good period. Now, from the midterm to long term, again, that goes into projections of what does this tightening cycle look like, or when does that occur. But I think it's going to be a struggle to find yield in the higher credit quality and shorter duration portion of the curve. And so, what does that leave? Well, you could look at taking more credit risk. You could look at longer duration, but again, that's additional risk. But we have seen credit spreads widen, and typically when you see credit spreads widen, there tends to be opportunity. But at the same token, from a default perspective, we're really just starting to see that process unfold out there in the marketplace, and so I would still be weary of in particular the below investment grade segment of the market. Now, from an equity perspective, I believe there's absolutely still risk premiums to be captured, and I think a lot of that falls on the different policies that are accommodative that are in place, from the Federal Reserve keeping interest rates low, and then also embarking on quantitative easing. We also have different currency index swaps that have been set up to help keep the flow of capital globally, keeping that moving. And we've talked about the actual supply chain, but the actual currency and the pace and exchange of dollars, keeping that flowing as well. And the Federal Reserve has two official mandates. It's to support full employment and to keep inflation in check. And as of late, really since the financial crisis, there's kind of been an unofficial third mandate, and that's to support asset prices. The old adage, don't fight the Fed. I mean, we've seen that equities have had a very strong run since the financial crisis, and a lot of investors believe that that's largely due to the support and the accommodative policies that they had in place. And we're still in that position today. So again, I believe that there's a risk premium to be captured within equities, but it'll be interesting to see when that tightening cycle, how that impacts that risk premium as well.
Yeah, for somebody that might be in a 60-40 portfolio or even a 70-30, what are some things that investors can be doing to prepare their portfolio for kind of these very low interest rates for the foreseeable future? I've heard some people ask, like, should I even have these bonds? Which I think you should, but I'd love to hear your perspective on that.
I think it all really goes back to if you're working with an advisor or you've already had yourself positioned in a risk profile that made sense for your needs and your timeframes for liquidity, it'd probably be good to just do a checkup just to make sure that that's still all in alignment. The pandemic has not only affected the allocation of portfolios, but it's affected a lot of people's personal lives. Some folks that we've been working with have been provided early retirement packages, and with that comes, I guess, an acceleration of their pension benefits. And so really understanding what things like that accelerated pension benefit can provide for you in the long term, and mapping that out or coordinating that with your allocation and understanding what type of cash flow can be generated, as I may not be having a paycheck anymore. And so I think really just checking in on your allocation, making sure that it makes sense for you, because ultimately it comes down to, based on the opinion that short-term interest rates and higher credit quality, you're not going to be able to clip that coupon as easily as you were before. What that really comes down to is encouraging the investor to take more risk, and sometimes that doesn't make sense. And so it's just checking in with your own personal financial situation and making sure that it makes sense for you.
Yeah, it might be a good time to rebalance and relook at what those financial goals are.
Absolutely.
Let's kind of wrap it up here with a couple questions. What does this mean from your perspective going forward for investors? What they should plan for this fall? We've got an election coming up. We have more stimulus likely in the works later this month. Another 1.2 million people filed unemployment. What are some of your thoughts there?
Again, it's very individual and dependent on each person's personal financial situation, but maybe let's break that down. Somebody in the accumulation phase of life, it still makes sense, save as much as you can. It may be more prudent of them to take a look at the different tax styled accounts and where they're allocating dollars. There's some potential for some significant tax increases and some changes to the current setup that we have. And so questioning things like, does it make sense for me to defer at the rate that I'm deferring? Or does it make more sense for me to take advantage of some after-tax savings programs? Things of that nature. So really the placement of those dollars, but ultimately from an actual investment perspective, if you're in your 30s and 40s, unless you're retiring at 50, you got 45,
some time.
You got a runway to take risk.
Yes.
And so that is a balance of your personal risk appetite as well, but the time frame that you have the ability to take risk. And so checking in on that, but also just the placement of your dollars, and maybe being more thoughtful with the type of accounts that you're putting those dollars into. Somebody that is about to retire, we already kind of covered that with just checking in on their portfolio, making sure that lines up with their time frames. But looking at things like their pension or Social Security, for that matter, coordinating their withdrawal strategy from their portfolios, from looking at assets that through a period like this that we've gone through, where equities have taken a significant dive, maybe there's portions of the portfolio that make sense to sell and supply your replacement of paycheck, but also mapping that out with the Social Security claiming strategy, and understanding your options there, getting serious about your true life expectancy. And that's not always the most fun thing to talk about, but you can help make thoughtful decisions about your claiming strategy if you're being transparent with that and honest with yourself. And then same for those that are already retired and drawing on that. Very similar. Just making sure that you're coordinating everything that you have and optimizing that to make sure that you're still able to meet your needs, not only today, but in the future as well.
Awesome. Well, I've got two questions to wrap up here. Thought it'd be interesting to hear your perspective on mutual funds. What is something investors might not think about when investing in mutual funds?
Mutual funds, and this may be a full, we could dive into this deeper maybe in another podcast.
Yeah, for sure.
But I think there's been a lot of buzz around ETFs, and ETFs aren't necessarily new, but they're becoming more and more prevalent within the investment community. And both accomplish they accomplish the same goal. I mean, they're a basket of different securities that help provide diversification, just packaged and put together and traded a little differently than each other. And just to give a simple answer, mutual funds really do help with managing emotions. You don't have the intraday trading that takes place. And through a period like the pandemic, when we saw a significant sell-off, what ETFs offer through the intraday trading is real-time pricing of securities, and that's good,
and can be bad.
But it's also scary and can be bad. I mean, you saw a number of different ETFs get close to zero. And in theory, if you're thinking about, well, what is the actual true asset value of that underlying ETF? Well, there's got to be at least some sort of inventory or infrastructure within those businesses that they own that still has value. So it's maybe not necessarily accurate pricing that's taking place, but again, it can create some panic through some more extreme situations. So for the most part, they accomplish very similar things, and both have continued to become more efficient. But from a simple answer, I think that just from an emotional standpoint, it's a little bit more protective.
Yeah, trading just once a day. All right. Early in the podcast, you mentioned some charts and things like that when we were talking about government debt. Where can people find us?
So you can find us at our website, WPWealth.com. We're also on LinkedIn and all different podcast outlets. So look for us on any one of those sites.
All right. Thanks, Bill.
Thank you.